Can Trump really destroy the IRS? Welcome to another episode of the More Money Movement, sponsored by WealthHealthSelf.com.
So, the man said he'd do it. Get rid of the thing. The Internal Revenue Service, the Gestapo in cheap suits, the guys who call you up, ask you questions. You don't know the answers. How could you? The code, it's this thick. He keeps a copy in his office. A licensed attorney. He's not your attorney, but he's got the book. It started as a soundbite. Of course, everything does. But now, the wheels are in motion. The budget slashed, programs shut down, and this new thing, the One Big Beautiful Bill Act. They always give it a name, like a used car. The executive, the marquee. Sounds good, means nothing. 100 years, they say, the biggest tax reform in 100 years. And anytime this happens, the changes, somebody gets angry. That's the game. That's the whole game. But the smart guy, the financially savvy guy, he hears the news, he doesn't get angry. He asks the one question, the only question. How do I use this? How does this new rule, this new twist in the labyrinth, how does it put money in my pocket? That's what we're here for. To look at the thing, to see what it is. First, the foundation, the big picture. 2025, an interesting year. The original idea, a beautiful idea, simple. Replace the IRS with the ERS, the External Revenue Service. Don't tax the citizen, tax the foreigner. A tariff, a wall of money. You send your junk here, you pay for the privilege. That money, it goes into the pot. And maybe, just maybe, it's enough. Enough so you don't have to fork over a piece of your paycheck. The man said it himself, instead of taxing our citizens to enrich foreign nations. You know the line. It's a good line. It plays. So how's it playing? Let's look at the numbers. The data doesn't lie. People lie. Numbers don't. 2025, a record year for tariff revenue. $300 billion. A number so big it doesn't mean anything. Let's give it meaning. It's not enough. The government, it's a hungry beast. It needs to eat. It eats $5 trillion a year. 5 trillion. Where does it get it? Let me count the ways. Let me list the bites it takes. 1. The income tax. You work, you get paid, they take a piece, right off the top. 2. The payroll tax. Social Security, Medicare, FICA. Another piece, for later, they say. 3. The sales tax. You go to the store, you buy something, you gotta pay a sales tax. 4. The capital gains taxes. You buy a stock, you sell it for a profit, that is a capital gains tax you have to pay. 5. Property taxes. You buy a house. Well, every year you have to pay property taxes on that house. 6. An estate tax. This is more reserved for the ultra-wealthy. If you die with a lot of assets and you pass these assets on, the government is going to tax you. 7. The tariff tax. This is what we've been talking about today. This tariff tax is if something is being imported from a foreign country. 8. Corporate taxes. So, a corporation, if they make a profit, they have to pay a tax on that profit before the owners get a penny. That's why it's called a double taxation. But you have the corporate tax, then you have your state and local taxes. Certain states charge much higher. And then I lumped everything else into number 10, which is other, which could be really any other tax, your toll taxes, cigarette taxes, lottery taxes. That's how the United States government is generating this $5 trillion. And this I know goes beyond some of the government taxes because you also have state, but the government is generating $5 trillion by taxing you in many different ways. But the problem is then that the United States government is going out and spending $7 trillion. That's the estimated budget for the United States government in 2025, which means there is a $2 trillion deficit. So going back to the original idea of using tariff revenue to replace the IRS, what we can see now based off of almost a year's worth of data is that tariff data is not enough to replace the total tax revenue from the IRS. And it's definitely not enough to replace the expenditure for the United States government.
Now, this helps us lean into what's happening with the tax plan right now and how it can impact how much money you're paying in taxes. This is where, to reduce this deficit, the United States government can do two things. They can spend less money, which means reduce their spending, or they can work to earn more money, meaning generating more taxes. And what we're seeing happen today is that the United States government is working to spend less money in certain areas. For example, I've already talked about how the United States government is cutting back on expenses at the IRS by laying off workers. So yes, we are seeing places where the United States government is cutting back on certain expenses, but we're not seeing this earning more happen. Instead, what we're seeing is the opposite. With the passing of the One Big Beautiful Bill Act, this is one of the largest tax reforms that we have seen in 100 years. Which means many people, in fact, most people, are going to be paying less money in taxes under the new plan. And so this combination together of some spend cutting and less taxes is anticipated to increase the national deficit by another $3 trillion over the next. So now that you understand the foundation, let's go deeper into the specifics because many of these items are being rolled out as we speak for the individual. The little guy, the guy who works for a wage. Change 1. The car note. You buy a car, 2025 to 2028. You finance it, you pay interest. Now you can deduct it, up to 10 grand, but there's always a but. You can't make too much. Under 100 grand if you're single, under 2 if you're married. And the car, it has to be made here. Final assembly in the US of A. So if you qualify, the government is subsidizing your car payment. Think about that. Change 2, the tip jar. You work for tips, a waiter, a bartender. That cash in the jar, the first 25 grand of it, tax-free. If you make under 150 grand a year, they're making tax-free what they can't track. A little nod to the cash economy. Change 3, the overtime. You work extra hours, you get time and a half. The first 1,200 of that, if you're single, tax-free. 25 grand if you're married. Again, if you're under the income threshold, the government is saying, we won't punish you for working more. For now, it expires. Change 4, the big one, the Tax Cuts and Jobs Act. It's permanent now. The rates, they stay low. If they hadn't, they would have gone up. The brackets would have shrunk. You'd be paying more. Let's break it down. The marginal system. People get this wrong. They think if you're in the 22% bracket, you pay 22% on everything. No. You make 100 grand, the first 12, 10%. The next 36, 12%. The next 52, 22%. It's a ladder. You only pay the higher rate on the money that steps into that higher bracket. It's a progressive shakedown. So for the individual, it's a net win. A few new deductions, lower rates locked in. For now. For the business, this is where the real action is. This is where they think you're not looking. Change 1, the 100% write-off, Section 179. This is a beauty. You buy a machine for your factory, $1 million. You can write the whole thing off. This year, your $2 million profit becomes $1 million for the tax man. But let's get spicy. Let's talk about the influencer. The kid on TikTok makes 30 grand a year, a profit. He wants to look like a player. He hears about this. He needs a heavy machinery for his business. He buys a G-Wagon, weighs over 6,000 pounds. Mercedes has a whole page on this. They know. He puts 20 grand down, finances the other 80. His clever accountant, he finds a way. Says the G-Wagon is 100% for business. 1 million views on a video of him washing it. Content. On paper, he writes off $100,000. He made 30, so now he has a loss, $70,000. He pays no tax, and he carries that loss forward to next year to shield next year's profit. He's got a $10,000 bank account, $100,000 truck, and a $70,000 tax loss. That's the game. Take it further. The real baller, he makes $10 million. He buys a $10 million plane, puts $2 million down, writes off the 10. Now his taxable income is $0. He's got $8 million in the bank, a plane, and a $0 tax bill. This is not advice. This is how they think. The accountants, the attorneys. This is the map of the minefield. You can tread carefully, or you can try to grab the gold. Change 2, the 20% pass-through, the QBI, Qualified Business Income. You run an LLC, a partnership that qualifies. You made $500,000 of revenue, and you have, let's call it $250,000 a year in expenses, which means as a profit, you made $250,000. Now, generally, you have to pay taxes on that $250,000 worth of profit. But if you run a small business, something like an LLC or a partnership that qualifies, what that means now is you're not going to pay taxes on all $250,000. On top of that, if you qualify for the special deduction, you could get a deduction for up to 20%.
You're going to pay taxes on 80% of this because you get to take a 20% write-off, which means you get to say, hey, because I am a qualified business owner, you're going to take a write-off of $50,000, which means you're going to pay taxes on $200,000 because you are. Change 3, the free lunch is over. Section 274. This one's a kick in the teeth. You used to buy your employees lunch, sandwiches, coffee. You could take a write-off for the value of the food and meals that you provided for your employees. So if you ran a business and you made, let's call it $100,000 a year, and you spent $10,000 on food and beverages for employees. I know that's a lot of money to spend, but you get the idea. If you spend 10 grand on food and beverages for employees, you could take a $5,000 write-off, which means, yeah, you spent $10,000, but you only get to write off $5,000.
which means you would have to pay taxes on $95,000. That's how it was. Well, now under this new proposal, you don't get to do that anymore. You're not going to get a write-off on food and beverages you provide to your employees. So even if you spend that $10,000 on food and beverage for employees, it comes out of your personal pocket. You don't get change for the student loan. If you work for a company and you have student loans, this is good news for you because now there are ways for your employer to help subsidize and pay off some of your student loans and not pay taxes on that money. Take a read. Student loan repayments made by employers to their employees were temporarily tax-free to the employee, but now they are permanently tax-free. And change number 5, which isn't really a change, it's an extension, is keeping the corporate tax rate at 21%. Let me diagram how this works because I think there's a lot of misconceptions on how corporate tax rates work. Let's assume you are right here and you start this corporation right here. And now your corporation goes out and sells stuff and you make money and you have expenses. So you make, let's call it $200,000 and you have expenses of $100,000. So now you have a profit of $100,000. By the way, this is not for LLCs. I'm talking about C corporations specifically. If you have this profit of $100,000 in this corporation has to pay a corporate tax on that money. Today, that corporate tax was extended to be at 21%. If this tax code, the Tax Cuts and Jobs Act, was not extended, it would have gone up to 35%. But it's going to stay at 21%, which means about $20,000 of this money, $21,000, is going to go in taxes. So now there's going to be $79,000 left in this bank account. And that's when you as the owner can take some of this money out. So let's assume now that you take out $50,000 for yourself as the owner of this C corporation. And if you don't know what a C corporation is, it's just a type of legal entity. Kind of like how there's S corporations, partnerships, it's just a legal term. It's a type of business. If you take this $50,000 out, now you again have to pay taxes. So that's why it's called a double tax, because you're paying taxes at the corporation level, and then you pay taxes when you pull the money out for yourself. So as soon as you touch the money for yourself, you then have to pay taxes again. And this new tax law keeps the corporate tax rate at 21% instead of raising it to 35%. So what we talked about in this video is how the tax plan has been changing. The original idea was to replace the IRS with the FISL. But what we have seen is that although we are seeing a record amount of tariff revenue, it's not going to be enough to replace the IRS. That being said, we are seeing some ways that the government is spending less money. They're cutting the budget for certain entities, but we're also seeing less taxes go into the United States government because we're going to see lower tax rates. These lower tax rates are going to impact individuals and they're going to impact corporations. They're going to impact individuals through things like being able to deduct a car loan interest rate, to be able to not pay taxes on tips, to be able to not pay taxes on overtime income, and to see lower tax rates through the Tax Cuts and Jobs Act. It's also going to impact businesses through things like the 100% Section 179 deduction, through things like the 20% QBI deduction, through things like the 2740 change, which will now not allow businesses to write off their meals and beverages that they pay for employees, through things like making permanent the student loan repayment plan that businesses can help repay student loans and not pay taxes on that money. And then number 5 is keeping the corporate tax rate at 21%. Now that you understand this, I hope you understand that there are things that you can do, such as the things I've just talked about, to potentially lower your. The question isn't whether the man was serious. The question is, are you serious? Are you serious about understanding the new layout of the board? The smart money, it doesn't get angry. It doesn't mourn. It doesn't cheer. It adapts. It looks for the angle, the edge. The code is a weapon. You can be the target, or you can learn how to hold the gun. The choice is yours.
For more success content, earning opportunities, and endless giveaways, be sure to visit wealthhealthself.com.